Recording in progress. Let's do it. So this is April 15th, 2024, another AMA. And so let's see, we've seen a lot of good action. The last couple weeks have had that MSTR play. Even last Friday was a little bit interesting with GLD. Does anybody have anywhere they want me to start, or should I just start reading off some of the questions? Or I could even just start. I think Ozzy wanted MSTR. So unless any other choices, I'm going to jump to MSTR. Okay, let's do it. Okay, so I think first things first is with any chart and any analysis, you always want to start looking at the big picture. And so MSTR has obviously exploded a ton over the last couple months. Everybody probably knows the deal with this, where it's trading at a large premium to the price of Bitcoin and everything. And so Kerrisdale came out short on 328, but keep in mind, yeah, we're pretty much sitting at all-time, I think it might not be all-time highs because of 2020, but we're sitting at local highs after a run-up of about 4x in the last couple months. So now we're going to jump to 328. And it's funny because I actually went over this today because I was recording the Top Ops video. So it's all super fresh in my mind. And so when we jump to the intraday, what we see is this short report came out pre-market, somewhere around like 9:15-ish or 9:10-ish. And we go down a little bit, but it's pre-market. There's not much volume, and we end up just opening flat. And really, everybody in the world pretty much knows that MSTR is trading at a large premium. So I had a couple of friends from my pod text me pre-market, and they're like, "Hey, Lance, like, what do you think? Do you think this can unwind?" And so what's interesting is I said, "Look, I'm skeptical. I think." I think this is already very known. I don't know if it's going to have any effect. But because it's a Friday, I think it's worth being open-minded to the zero DTEs. And really, like, it was really my pod that kind of convinced me that, like, okay, you're right. Like, it's a catalyst. There is asymmetric skew if this were to crack. And so when we're trading flat pretty much off the open, I don't think you necessarily, like, if you want to YOLO on some option premium, that's fine, like, just because it's so asymmetric. But I personally would not have any equity in this middle range. Once we break the lows on the opening range, that's when I think, okay, maybe you go into some of these zero DTEs, maybe you do a starter position. And so what ends up happening is we do end up cracking and breaking prior bar lows on the daily. So that itself is kind of like confirmation now. Like, now we've made a decently meaningful move and everything. And so I say this in my review video, but you need to recognize that probabilities are always changing every single bar that happens. So when we're just trading flat and doing nothing, I'm somewhat skeptical. But once we start to crack, now it's kind of like game on. The odds of this making an outsized move are way, way, way increased. And the best analogy I can give is this. Imagine if you have 8 queen in your poker hand. Pre-flop, that's kind of like not that great of a hand. It's kind of shitty, right? Maybe it goes, maybe it doesn't. But in poker, if you ever watch on ESPN or whatever, as the hand unfolds, you see all those player percents differ as that unfolds. And so once this cracks, the percentage of an unwind ends up going way, 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 way higher. And so we have a bounce, but then we consolidate very, very tightly here. And so especially as we break 825 or so after that consolidation, that to me is kind of the money shot right there, where that's where you really want to hit the equity. That's where you even want to go into more of the puts. And this ends up making a beautiful, beautiful leg lower. And the beauty of those puts is it's just so asymmetric. Even if you initially start with something like, I think the 1825s were like a couple bucks at the beginning of the day, and those were eventually worth a couple $100, which is crazy, crazy insane. Again, the way I want people to think about this is you can then reverse impute like what those ascribed percentages are, right? If you can make 100 to 1, that implies essentially that's only a 1% chance of happening. But I would argue this is especially once this is cracked, it's much, much higher than 1%, which just kind of is a quick, just back of the napkin hack to just say, okay, is there some edge on this? Right. And if say it went $200, but the price of the puts were $20, that would be implying a 10% move. Do I think this is potentially cracking 200 points with greater than 10%? I don't know, but it's probably somewhere around 10 to 20%, but definitely way higher than like the 1% that gets implied by the options market again. And that's kind of been one of the biggest themes of this year. Oh, by the way, so once this then does that capitulation, it never really capitulates in price, but we do get a ton of volume going off. And then we essentially stay range bound in no man's land for the rest of the day. So I really won't touch it anywhere in the middle besides that. So any questions on this one before I jump to GLD, which I think is kind of similar? Yep, hit me, John.
Hey Lance, I just have a quick question. I'm a noob when it comes to options. So I was just
Yep.
wondering if the risk reward would change if you express the short in an like if you buy some puts or if you just short the equity.
Yep. So definitely. Oh, and so one thing, actually, let me kill two birds with one stone. Someone asked, would I be selling, would I consider selling calls here or would I buy puts? And so essentially there's different ways to express a trade. And certainly with options, you can get infinitely complex in how you can express a trade. And so selling calls have one risk profile, shorting the equity has another, and then buying puts is different. And so the highest probability win is selling a call, right? If I were to sell a $2,000 call, the probability that that wins is very high. But if I were to buy a $1,700 put that day, the probability of that is very low. And so depending on your own personal spectrum of the outcomes, that's where you can have a view that differs way different from the market. So if my belief is that this could really crack, like if I think, oh my God, this is totally going to melt, like SMCI that one day a few months ago, like SMCI wasn't going to go down 20 points. If that's cracking, it's going down 200. And this type of thing, you're not really looking for a $20 move, or you're not really looking for it to stay flat. You're thinking if this cracks, this could really unwind. So when you go into the puts are essentially offering potentially like 50x, 100x because there's zero DTEs. The reward on them is so asymmetric. So you could risk $1,000 to $2,000 in premium and potentially make 100 grand. That being said, for selling a call, yes, it's probable that you're going to pocket that money depending on the strike, but you're at the maximum you can make is 100% of that premium. Now, equity falls somewhere in between. You're really not going to get the same skew on your risk. Because depending on how you do it, like this is, say you short here with equity and maybe you're risking, I don't know, maybe you're risking 15 points or so. Yes, you probably make 15x that or 10x that, 10 to 15x your risk. But the difference is these puts, I'd have to look up the options pricing on what they went to. But I would imagine if the equity increased 10x, these puts probably increased 40 to 50x. So depending on your confidence and your view of just how far something will go, that's how you determine how you want to express it. The more confident you are in how far or how big the unwind will be, the more beneficial the puts will be, especially with the timing and especially when this is all lining up on a Friday. A lot of times I don't think these option plays would be worth it if it wasn't aligning with a Friday where the options market just prices so many of these things is very unlikely because there's only potentially half a day left or a day left. And so one thing I'll bring up does that help for now? And there's one point I'm going to even add more on that.
Yeah, that makes sense. Thank you.
Cool. So now let's take this GLD. So gold had been rocking, right? We break out of let me actually even go to a really long-term chart. If I'm not mistaken, Yeah. So this is a beautiful setup. And honestly, I don't do enough with the trend, which is kind of a shame. The best money's with the trend, but this gold breakout. So essentially 195-ish is kind of all-time highs. And even on the daily chart, we really set up nice. So buying this 195 break for a swing is actually super, super appealing. And I really just don't do enough of that, mostly because I tend to be more reactive and I'll trade the stuff that goes crazy the other way rather than like, I don't really actively back in the Trillium days, I'd use Stock Fetcher and I'd be running all these scans and I'd be watching for patterns like this. Nowadays, because I'm just so much less percent attention span on this, I don't really see stuff like this. But it's worth you all thinking of like, how can I run Stock Fetcher filters or whatever filters to catch some of these big picture moves? And so this ends up making a beautiful, beautiful leg. But now keep in mind, this now goes almost 10% in a couple weeks. So that is a pretty wild move, especially for something as boring as gold. And so that's a little too zoomed in. So what happened was we go from essentially another breakout from call it 205 to 220, and we break out on 4-11 of that mini range. And so this day, which was last Friday, we gap up and then we run pretty big. And so I know Alvin actually played this in 0 DTEs, which was smart. But to your question of when do I go for equity, when do I go for calls, or when do I go for puts? Because this had the down day here. I wasn't so confident that this would necessarily melt like it did. And maybe I should have honestly gone for some of the puts. But the way this was moving, even though I wasn't confident we would collapse this day or anything, I did feel like, okay, I'm willing to sell calls here. And so what I ended up doing was I sold like some 230s for next week. And because at that point, what I'll do is I'll zoom out. And if in 1 week this went another 5 points up there, that's a really, really sharp move on something as boring as gold. And I was selling an amount that I'd be pretty comfortable with if I got exercise. So even if I got exercise on that, that would kind of just be like a position swing trade for me. We do end up selling off. So then I ended up, I mean, gold bounced back today, but off the open today, like those calls that I sold were pretty much worthless. So you can make like 90% of your thing, but I'm sure like the 0 DTEs went up a 50x or something crazy again. But I personally was not that confident off the open, but then this ended up doing just a pretty crazy amount of volume. And so one thing I would say too is based on like the whole Lance theory of just like huge capitulation volume bars, like this was a pretty legendary amount of volume that went off yesterday in this. Let me see if anything, well, the weekly won't be so great, but I kind of suspect this might still remain the high for a while, just given like it seems like peak geopolitical tensions have passed in the Middle East and everything. So this is the type of thing where it's like, I'm not opposed to, I really would have seen this touch like 223-ish and really eat into this bar. But that's the type of play, like we've discussed a couple of times, looking for the lower high. That's the type of thing where like if this, shot down off the open, then retraced up to like say 223, 223.50, I would have been willing to short that against 225. Just under the assumption that with all this volume and all that capitulation, this is more than random likely to be the top on that. And so that's the type of play where I would probably use equity if it did go up there. Or that's the type of thing where you can even potentially still, not that I'm as confident in this, but you could potentially still sell calls if you suspect, okay, I suspect 225 is going to stay the high there. So that's kind of how I think about these things. But honestly, like this year has been so different from every other year just because the 0 DTEs have just been on fire. Like every single thing is always melting on these Fridays. Whether you look at SMCI, NVIDIA, MSTR, GLD, like that's man, I really do think the options market is just driving so many of these moves, and it can just unwind so much further than you think. So yeah, I'm already open-minded to doing this stuff, but it's like you should even be more open-minded than I am, I guess. Um, so yeah, any other questions for now before I kind of want to also jump into Golf Lima again.
Differ from some of the other kind of tiptoe.
I'm sorry, you're cutting out. I couldn't hear that. If your reception's bad, feel free to like throw it into chat. If you throw it into chat, I'll see it there. Any other things?
Hey, Lance.
Oh yeah, Drew. Yep.
Yeah. Hey, thanks. When you're talking about buying the puts, that's the day that it breaks. But you mentioned something about the difference in applied volatility when you have these big moves. How would you play, or would you play the options at all on a bounce? On a capitulation day, if you want to try to get the bottom, or do you?
So, let's talk about that maybe in relation to Golf Lima. Were you thinking of a specific ticker, or can I talk about that in relation to Golf Lima?
Yeah, that's fine. Obviously we played the GL yesterday, as that's fresh in my mind from one that I traded. But
yeah, let's do.
I'm open to whatever. Yeah.
Yeah, let's see that. So, what day was this? This was 4-11. So in general, I really want to play options. Only kind of before the crazy big move has happened. So the issue with Golf Lima, and so just to be clear, specific to your question of during the capitulation, right? Like in theory, you could have just taken some YOLO puts, or even call around $85. You could have done some YOLO puts and bought those. But your specific question was in regards to the capitulation.
Correct. At the turn. Yeah.
Yeah. And so here's the issue with that. And so actually, I won't say names, but Mr. Swang, my good friend, kind of messed this up, and it hurt him. So the issue with playing options around here, especially long options, is the implied vol at that point is just way too expensive in my view. I think the $60, like around here, the $60 calls we're going for weekly is just 1 week out. We're going for $6. So to even just break even, you need 66, and to make 1x, you need to make it needs to go to $72. So it's nice in the sense that your risk is capped, but for me, that's just way too expensive. And so actually, like what I thought was kind of the better play is, so I was long equity from, call it, I don't know, 42-ish. And once this bounced, like I was pretty confident this was going to have some type of bounce. And so once we bounced to 50, what I used then is, because the implied vol, in my opinion, was so high, I actually did the opposite. So I was long stock, and I knew I didn't want to have my whole position overnight. Just because that's just, I wasn't going to sleep well if I did that. So I reduced to about like 10 to 15K shares into the close. But what I did is I sold the $60 calls against that, because I felt the implied volatility was so high. So what's amazing is, like, if I sold those $60 calls, it might have even been more than $6. I think I sold them for like $7 to $8 or something like that. And so if you think about that, if you're buying 42s and then you're selling that $60 call for $8, your average price is effectively $34. And like, man, even if some horrendous stuff happens on earnings for this company, like it's really hard to imagine this being like a sub $20, sub $25 stock. So that's kind of how I viewed that. The other thing too is, I think like some people think like this stock is just gonna like magically go like 80 plus or 90 plus. In my view, it's just like, I don't really see this just super easily getting back into the 80s after all this, unless they just announce something totally crazy on their earnings that just puts the whole thesis to bed, which seems nearly impossible, but who knows? Yeah, I guess my point is the calls weren't appealing to me because they were so expensive, and my spectrum of like possibilities of how this is going to end up is I was skeptical of some major huge bounce. So because of that, I was happy to sell the 60s and kind of pocket the premium against the equity long, which then allows you to still make a huge chunk of points. Does that kind of make sense?
Yeah, it does. Would you consider shorting puts?
So yes. Yes, but I would say that also you want to be so shorting puts is complicated in this one too. In general, I would say I'm definitely open and into shorting puts. Here's why this one is a little bit tough. With selling, like, so first of all, I had too much equity where I didn't want more long exposure. So for me, it was going to be just a no-go. But the issue with shorting the puts is like, I don't know. I mean, maybe it was worth it. I'd really have to see what the pricing was. I remember looking towards the close. Yeah, I don't know. Here's the issue with the puts though, is like I really wanted to potentially just catch this bounce. And so if I'm selling those, I think this sticker only had monthlies, right? Which were for expiring this week. So my fear is if I were to sell the puts, I'm most confident in this bounce right here, right? The shorter the time frame, the more confidence I have. I'm more able to predict what's going to happen in the next half hour than I am in the next day or the next 3 days or 3 months or 3 years, right? And so the longer the time frame you go out, the less certain I am. And so with the puts is if this were to bounce from 40 to 50 like it did, those puts are not going to go down as much. And so I really wanted to be taking off a ton of exposure, even on this bounce, even from 42 to 50, I was taking off a bunch of exposure and especially after hours, right? And so with the puts, I can't take off any exposure after hours. I would then need to be selling stock as some type of hedge. And then you're dealing with the time value on the puts. So like, for the most part, I kind of wanted this trade to probably be done within a day or two, just because that earnings announcement is kind of like a lot of randomness that I don't necessarily want to play. So in summary, like generally I'm open to it, yes, but specifically because I felt this first bounce was just so probable and I wanted full exposure to that. Like I suspect if this went up $10, I suspect the puts probably went down. Obviously, it depends the strike, of course, but if they were out of the money puts, I suspect those only went down like, I don't know, 3-4 points. Does that kind of make sense for all that?
Yeah, it does. In fact, I actually screenshotted the picture of how they moved. It
Was I right on that then?
Yeah, I think realistically you could have got them at they say 20 and then bought them back at 16. It's my guess.
Well, so think about that is like, and what was that, like a $40 strike or what strike was that? Do you know?
They only had 60s. That's at least.
Oh yeah, because that was the lowest strike. You're right. You're right.
Right,
well, so the thing is,
yeah,
that's right. I forgot they didn't. I mean, it's funny how they didn't even have that. Because why would they?
It melted so fast. Yeah.
Well, so what I would say is, especially with those 60s, like that's effectively in the money. It's so far in the money at that point where it's kind of similar to being long the equity, but I would argue like for exactly that reason, the equity still performed better. But keep in mind, if it's a $60 put and it's that much in the money, you're taking on 1-to-1 downside on that, right? If this does, stick the landing or go to 20, you're going to lose the same amount, but otherwise you're dealing with the time value in there. And guys, I know this is, I know most people are not options pros. I know most people aren't necessarily in options at all. So I'm sorry if some of this stuff is a little technical and high level, but I'm sure some people will find this pretty interesting. So yeah, that kind of, you kind of get a feel for some of this stuff. So yeah, it doesn't shock me that those puts didn't, move anything so great. Anything else based on this? So this GL, yeah, I mean, so the other thing too, not that I wanted to I didn't want to I did the public video on this and I didn't want to really spill too many beans on this, but like, if you run the data, the probability of this gapping up to me was so ridiculously high. I definitely kind of pussed out on the overnight just because I don't really want to affect my sleep anymore. But this is the type of play where I would used to have so much size on it, and my confidence that this was going to trickle up after hours, it was going to get a rebuttal, it was going to get a defense, was very, very high. So that's something you guys really should track data on. And it's something I kind of underplayed on the video just because I don't want to give away all my data and everything else. But yeah, if you look back through all these, the ones that mega capitulate like this and their post capitulation backside bouncing, this was really, really high probability to me. And not that the bounce the next day was anything so crazy, but to make the 8 to 10 points, that's pretty damn good. Obviously these are risky, these are scary. You don't want to size so huge because I have seen some of these be a disaster, but I do strongly feel that in the aggregate, when sized properly, these were good trades. What else for me for now? Anybody have questions before I jump more to some of the online ones? Okay, let's see. So Drew had asked online about order flow tools. And so Drew, can you elaborate on that? What do you consider an order flow tool? You mean like, I know there's like some apps nowadays that track the amount of like volume at different prices going off and stuff.
Yeah, I do it mostly for futures, not for equities. But you know, things like Bookmap shows you where the liquidity is. Things like footprint charts, TPO charts. I don't know if that's any of this. You use any of that?
Yeah, it's so I don't and have not used some of that, but I do kind of conceptually see the value in it. And so here's the thing: is at Trillium, we would have just full depth of book for all the ECNs. So we would always constantly be scrolling down, looking at the bids, scrolling up, looking at the offers. I think it's so important to know where the large bids are ahead of time. Like even in this GL, if there's some massive 200,000 share bid or 400,000 share bid at $35, I want to know that ahead of time. And I want to have my bids just totally pyramided at like 36.60, 37, 38. So it's definitely important to do that. I think those tools can be useful. I think a lot of traders probably don't have depth of book at all, which is crazy to me. I think other places where that stuff's super useful is in IPOs. To not have depth of book on certain things, you're kind of just, especially if you're day trading, you're really harming yourself. Who the hell wants to buy under some huge, massive offers? Who the hell wants to short in front of some large bids? So I do see value in those tools, even though I can't necessarily speak to like the mainstream mass production ones. But I do think it's so important to have a good feel for how much liquidity is on which sides and everything like that. Yes. Okay. So let's see.
Hey, Lance, I got a quick question.
Yeah, hit me.
I wanted to ask you about a specific ticker on a specific day.
Yeah.
So MESO on April 1st. I was studying the bouncy ball setup and I wanted to get your thoughts on this one.
Sure. So April 1st, let's look at the daily first. So essentially this stock had been $2 and had really run up and is getting a little euphoric there. So that's the daily. Let's jump to the intraday first. And are you talking about this whole consolidation here, then this break?
I was thinking about the break around 1206, but yeah, there's a break afterwards as well.
1206.
I wanted to know if that was a valid spot, and because I took it and lost on it, so I just wanted to know if you think that was like fair logic for that.
So the only thing that kind of bothers me is just that this is still within the middle of the range. if this first opening bar didn't go down and the low of the day was there, I think this would be totally fine. That's the one con on it. It does seem, at least just based on the ticks here, obviously I wasn't watching this that day, but it does look like there might just be a buyer there as well. It's 605 that was probably holding it. So I don't think there's like, what I'd really have wanted to see is this be the low of the day. Some of these bounces be a little bit less vicious because this is a really strong up move. That being said, I don't think, because of how tight we are here, I don't think this is really the worst thing either. Like, because when these bars right by there are so tight, you're just not going to lose that much. Because the range is what, like 10 cents on a bar. So I'd put this in the category of like, don't love it, but don't hate it. And those would be my criticisms for what I would have wanted to see otherwise. Like if we take stuff like Apple on that one day, if we take like some of the ones I've documented, call it Ford, Nikola, CAPT, Apple, all of those have been the lows of the whole range. And I think that just helps with the win percentage overall. And so what you'll find is that, like, to find success, it really takes stacking up all those little nuances. So many times people will be like, oh, is this setup like ABC setup? And it's like, well, no, because of this variable, that nuance, this little nuance. And that's kind of the beauty, in my view, of trading, is it's refining those little nuances time and time again. So that, I think, making that change and being aware of that would help increase the win percentage and prevent stuff like that.
So based on your comment for the low of day, is the reason low of day is important in this scenario is because low of day is more significant level to more participants or potential liquidity there? Or what are your thoughts about that?
Yeah, I think it's just psychologically just the thing that tends to be cleaner.
Okay.
Yeah, it's essentially just that. And I think it's just also a natural place for a lot of people to have stops. I think it's also a natural place for a lot of people to want to enter positions. So if we were to look at NVIDIA on its exhaustion day, if we were to look at MSTR on that day, a lot of those, even SMCI on the day that cracked, a lot of these things really, in my view, trade cleaner once they break that low of day. Again, it's just one of those things where I think when you follow these minor nuances, you're each thing you stack up, you're just slowly increasing your odds a little bit. And when you stack like 10 or 15 of these things together, you finally beat the hurdle where it's like expected value greater than 0. But in my personal belief, unless you're stacking all these things together, okay, it's the daily chart lines, the intraday, the box, the this, the that, news catalyst, super in play. Unless you're stacking so many variables together, I think markets are just too efficient. And I'd also argue this is why in those academic studies, when people are like, oh my God, technical analysis doesn't work, moving averages don't work, this or that doesn't work, support resistance doesn't work, it's because these academics aren't stacking enough variables in their favor. They don't know what an in-play stock is. So when you don't have enough of these criteria, it then becomes just no edge. And I would argue this is kind of the same thing as fundamental analysis, right? Like if you're Warren Buffett, what you're doing is really figuring out like a zillion things, and it's all these nuances all being the best, and that's required just to even stand a chance of beating the market. So I do think all those nuances, and as silly as it sounds, yeah, I do think like a 20-cent difference, you're more likely to get more people stopping out, and short, a stop out meaning selling is the same as a short. So I think you're just getting more people aligned with your perspective.
That makes sense. Thank you.
Yep. Anything else for me now before I jump into some other questions?
Hey, sorry.
No, go for it. Go for it.
Hey, Lance. In your GL video, you talked about how you were game planning the volatility halts.
Yep.
One thing I had a question about is how are you kind of thinking through that when a stock halts? Do you go through like a checklist in your head? I know that was on your DRC too, that you need to be game planning halts. Can you kind of walk us through how you were thinking about it and what you were thinking about?
Yep.
Thank you.
So the main thing is you just never want to be caught flat-footed, especially for NYSE stocks. I don't think this has happened in a while, but sometimes NYSE stocks can just open. If they're managed by a market maker, sometimes they can just open. They'll get delayed and not follow the 5 minutes. Then they can be halted for a while, then take people by surprise, and open at weird prices sometimes. So one thing I always want to do is be thinking, where could this open? And it, especially on NYSE stuff, because of that reason I just mentioned, it never hurts to have like just stupid bids and things. Not that I did this myself, but assuming you want the stock, which I would, there's probably no bad reason to throw like a $22 bid or something in there, right? If this were to open all the way down at $20, I would definitely want a ridiculous amount of that. So things I'm thinking about during these halts, a good thing is just to really test all your assumptions. Is there anything I'm missing? Is there anything I'm overlooking? It's a good time to just take a deep breath, right? It's so easy to sit here and review stuff, but in the moment, there's a lot of adrenaline, there's a lot of cortisol, and when we get into fight or flight mode, we're not necessarily thinking our most rational. And so I think those halts are just good times to say, do I really like this play as much as I think? If I had no position in this, how would I feel? Where do I want to get super, super, super aggressive? What am I looking for? So, okay, generally I want to get the most size I can on the turn. I want to wait for the backside. I want to wait for break of prior bar highs. And the other thing I realized during these halts was I was pretty confident that once this thing did turn, it was probably not going to have much liquidity. And that, like, I think a lot of people on the YouTube video were surprised that I got so much stock on the front side. And I would make the argument that my reasoning that there isn't going to be that much liquidity once it turns was actually dead right. Once this did turn back above like 40 or 41-ish, it just went boom, right to that upper limit. And at best, you're getting partial fills there. And so many people are waiting for that moment to then hop on the bandwagon. And so if I didn't get so much stock on the way down, I wouldn't have been able to. And so during those halts, I'm really just making sure, okay, do I actually want this? How much do I want? At what levels? And I think it's always good to really think of before you're in the fight, it's really good to think at what price would what would have to occur for me to absolutely lose my mind? Oh my God, this is so insane. And so I was well aware that if this went to say $30, I was going to go absolutely nuts on this thing. So I sometimes refer to a sweet spot. And so for me, that was kind of going to be my sweet spot. And so you might ask why for some of this. So really I view the breakdown level kind of as 85, and we went roughly 30 points or so. And so a symmetric 30 points seems pretty ludicrous. In my opinion, I didn't think that was going to happen. 30 points would take you to 25. So if we got anywhere remotely near that, I was going to have just, I don't know. My guess is if this went to $30, I probably would have had, I don't know. It would have been a disgusting. I probably would have had 150,000, maybe 200,000 of these, because it's just so asymmetric at that point. The odds of you taking a meaningful loss on that is just so improbable. There's a potential for you to make 100% in like 2 days. You're not losing 100%. Like even if this company eventually goes bankrupt, this is going to be so drawn out between the lawsuit, the allegations, all this crap. Like you're not taking meaningful impairment on that. So I think it's really good to really think, what is my sweet spot? How much size would I get there? What am I looking for on the turn? And just testing your assumptions. There's been times where you're in a position and it halts, and then you're like, oh crap, like, damn it, I'm trading like an asshole. This isn't what I wanted to do. I've got too much risk on. And then you just kind of do damage control. So it's just really good to take a breather and reassess and reflect. And so many people, especially in an office environment, will kind of just that's when people start complaining, joking, doing whatever. And it's so important to train that for yourself or for your pods. This trade's not over until you log out. And even once it was bouncing. So here's the other thing I would say too, is a lot of people will start to worry about, oh, am I going to overnight this, or how much will I overnight, or all these things. And so a lot of guys on the call were worrying about that. And for me, it was like, look, I'll worry about how much I want to overnight closer to the close. I don't know whether this stock's going to be at $30 or $70 by the close. So I try not to worry too much about decisions that I don't really need to be making right now. All I care about is, what are the bars in front of me doing? And I think it was so interesting that once we go from 40 to 50, we break prior bar lows, and we can't even go down a bit. This consolidation after that bounce, that was such a good sign that this was going to continue. If the market didn't close, I really think this had that second leg. Yep. Then I think was that good, Ozzy?
Yeah, that was amazing. Thank you so much.
Yep. McCaff?
Yep. Speaking of GL, I was wondering, like, if the bounce or if the capitulation would have been like midday instead of like near the close, would you have like put on more size, or what was your thought around that?
I don't think I would have put on more size, just because I kind of feel like I already got probably slightly. I don't think what I did was super nuts. I think I probably got slightly more size than I think I was a good side of aggressive. It was risk I was willing to take. So I think I got pretty damn aggressive and was happy with my sizing. I don't think I would have got more size, but I do think if it was midday, I would have just simply held way better. The reality is the liquidity after hours is just going to get way worse. So I sold just a really good chunk into the close because I didn't want to deal with shitty liquidity. And I also just didn't want to have so much stock overnight that I wasn't going to sleep well. So I don't think my sizing would have differed. I do think my ability to hold would have been much improved.
Yep, fair enough. And I was just wondering, so I mean, you said obviously that you thought that this was like going to bounce in most case. What was your plan for exiting the trade? I mean, obviously, I think that you probably had like some sort of game plan for if this thing would have gone to like 30 and you were, out of the money by a few points.
Yeah, and so a lot of people on the YouTube channel, and it's a really good question to ask, and it's an important point for me to make now, is they were asking, if I'm buying on the way down, what was my stop? And I know some people will be horrified to hear this, but on the way down for what I was buying, as long as it's capitulating and waterfalling, I don't have a stop. I am accepting, and that's the beauty of a long versus short. I am accepting that risk. And I'm also recognizing that, oh my God, if this even goes to 25, this is going to be one of the most insane, amazing ops ever. So it's one of those things where it's just like, okay, so be it. If I have 30, 40, 50K, I mean, being down 20 points. Well, actually, let's think about it. So even $25, 15 points away from 40, say you have, I don't know, 40,000, 40 times 15 is 600K. That's an acceptable level where I wouldn't have been that freaked out. So there was just no place where I was going to hit out as long as it's capitulating. But now let's say the stock tries to bounce and it fails. Like in here, oops, I zoomed in too much. So say I'm buying on this way down in here, and then we try to bounce. If this consolidates and rolls over, I'm 100% getting out of everything. So let's say if you just take this whole consolidation and you move it down here, if it happened at 40 bucks and we rolled, I probably would have, I'm not sure I would sell everything, but I would definitely be selling maybe half or more probably. Somewhere between 50 to, depending on how shitty the bounce is and how everything looks like, I'm probably selling between maybe all of it to at least 50%. So yeah, I was, for the most part, by the way, like anything that's capitulating this hard, where like you go from 60 to 38 in 15, 20, 30 minutes, the odds are just so good that you're going to get some type of bounce at some point. And the way to think about it too, as far as 50% retracements, is this went from 55 to 40. So that was 15 points. The 50% retracement is 47.5 or so. Now imagine if this went from 55 to 30 or something. The 50% retracement still puts me somewhere in the low 40s, which is kind of where you're starting to buy anyways. So you really, in a capitulation this sharp and this severe, you really do end up with a lot of leeway, where even if it does go lower, like the odds of it just eventually settling in higher was pretty good. And again, I'm only doing this on very, very select situations. The only reason why I would ever do this is because I felt so strongly about this data, and having seen so many of these and knowing that the stock came from 105, it's very rare that I do this. I don't want people to get the wrong idea and do something risky. This is an extremely risky thing. So, but yeah, that's how I felt on that.
Hey, Lance, can I ask you one thing about this that I haven't heard you talk about? Is what about adding? When you know you're right, when you see the turn, that first green bar, do you have enough shares, or would you add?
So once it turns, you mean if I was able to?
I mean, you were able to, I imagine, right? Once you saw that turn, you had confirmation you were right. This is the bottom. Would you add, or do you add, or do you feel like you took enough on the way down that you didn't need to?
Well, so that's generally where I want, in theory, that's where you want most. And that's, well, in theory, that's where you'd want all of it, actually. Like if able to, that's where you'd want all your stock. Yeah. But that liquidity was not there. And so here's the thing is, if you're a much smaller trader, like if you're trying to get 100 shares, 500 shares, 1,000, or even 3,000 shares, you're going to be able to get that or most of it on the turn. But for the size I wanted, like, so yes, I had some huge stop order in somewhere in there, taking it up to the limit up. So I did want to add there and get most of my size there, but I knew that was not going to be likely. And that actually panned out as true. I don't know if you guys were trading this, but like once that turned, it was insanely hard to get liquidity on that turn. There just wasn't that much.
Yeah, I had a buy stop at 41.01. I took 25 cents of slippage, and I'm not trading your size, right?
Well, and I would say that amount of slippage actually isn't that bad at all. That's not even bad. Like that's great. And but so I guess this further emphasizes like my belief that this opportunity was just so good. Because when you're buying on the way down, your expected value is way worse. You're taking a lot more risk. It hasn't turned yet, yada, yada, yada. So 100% yes, in an ideal world, I'd be doing what you did. But because I already liked it so much, I just knew like the bigger risk for me was not getting the size I wanted. But yes, you're 100% right. Then the other thing is gap risk is real. Right. This ended up kind of still trading at like 44-ish or whatever, but there is a realm where this gaps at like 46 and is just gone. I would say this was a good bounce, but not a great bounce. And there will be times where once that thing turns, like you're just getting so much worse prices and everything else.
Yeah, that's a Lance problem.
Yeah,
Your share
it's a Lance
size.
problem.
It's
Yeah,
not a me
and
problem.
it's important, like, for people to be prudent with this stuff. Is like, what's right for me might not be right for anyone else, especially in a play like this. Like, there are some rules to break at certain times. And ultimately, it's really ideally just the concepts that people kind of make their own. And I think that's the important thing, why we always say, like, you need to do what's right for you and make it your own. So if you're able to get the size on the turn and follow the right side of the V, that's perfect. And you need to recognize that for you, because yeah, what I was doing was extremely high risk, and it's something I probably do a couple times a year, and that's not much. That's pretty rare. Okay, so let's see, what else do I want to touch on? So one thing that I thought was a good question from Ben was, he asked, what was the best way to configure your monitors? What information would you display on your screens, and how is it arranged? And so I think that's a good thing to bring up, what I would call the monitor sweet spot. And so obviously my layout used to have a zillion monitors, and for the speed I was trading at, you wanted all the most pertinent information as close together as possible. So let's say you just have 4 monitors, 1, 2, 3, 4. I would try to pull the most important information all towards that middle. So I would have, for example, my Bloomberg filter, I would have my stock price spike filter, I would have my level 2 box that I would trade out of. I would have the order, the ECN book, all kind of as compact as possible. So then there's stuff that's not really that critical to my trading. If you think about email, if you think about a audio squawk like Trade the News, if you think about secondary news sources like a Hammerstone or whatever, those are types of things that I don't need to be having my eyes on every 2 seconds. And so the less pertinent, urgent information is going to be further away. The more useful and critical information is going to be as close as possible. So a Bloomberg HOTS filter is going to be in my eye of sight, my line of sight, at all moments in time. I'm going to have the level 2 box that I'm trading out of in my line of sight at all moments in time. And so I think it's just a good concept. Not that this time is so critical to most traders, but I do think, even just from the perspective of eye strain and everything else, and making it easier on your eyes, the less your eyes are flipping across a zillion feet everywhere, it probably does help to get your stuff as close as possible, and try and engineer this stuff so you're just not beating yourself up too bad. So let's see, we tackled Drew's questions that were on here. So one question that I think is pretty good from Monish. The question was, with the bouncy ball shorts and longs, I find that oftentimes I get faked out on my initial entry, and then the stock sets up for a higher odds entry later on with more basing. And so therefore, how do you size these? Because I find that later on, like, I can lose initially, but then they work. And I think this touches on a really important nuance, which is length of consolidation. And much like it came up earlier with the no man's land in what was that ticker? MESO. You eventually get a feel for what an optimal amount of consolidation is. And so Monish is alluding to the point that after more basing and consolidation, these tend to work much better. And I'd say that's totally true. And so he's asking as far as the sizing. And so what seems so counterintuitive to some people is sometimes you just need to let the subpar setups just let them go. And it's, if something doesn't consolidate enough, it's okay not to trade it. If something is in no man's land and it's not breaking the day's range, it's okay not to trade it. And so many people will have issues letting these trades go because some of them work, but it's okay if some of them work. I'm not trying to win 45-55. I need all these nuances to push me to 55%, 60%, 65% win rate. And so those things are finding the appropriate amount of consolidation, trading only tickers with in-play catalysts, like when Apple has the DOJ whatever stuff, when Ford has earnings or Nikola has earnings or whatever, waiting for the amount of consolidation, making sure that every subsequent bounce is weaker and weaker, making sure right before the break it's super, super tight and weak and defined. All those things start to really increase your win rate. And I'd argue if you're missing some of those characteristics, you don't need to trade those at all. And so whereas some people want to size down on those, which obviously is better than sizing normal, my argument to people is if it's in no man's land, if it's not got enough consolidation, if the ticker's not in play, maybe the more optimal strategy is to not trade that at all and instead allocate that risk to the 0.1% of setups that do meet all the criteria. And so this is a thing that I'm going to touch on in the course is really all the stuff I'm trading is such the 0.01% of setups. How many tickers, how many $10 billion companies have we seen fall 60% in one day? How many companies like this have fallen 60% on a short report? How many have mega capitulated like that? This is, at least to my knowledge, I think this is the biggest move we've seen this year, right? To the downside. The biggest upside move this year was probably SMCI as far as like overall craziness. Secondary to that is especially market cap adjusted stuff like NVIDIA. And so every year, if you were to look at my best trades, all of my best trades are like the really far out percentiles. It's, oh my God, the stock that has puked some crazy percentage, the stock that's gone super euphoric, or the headlines that are just so crazy, obviously slap you in the face. ABC company to buy XYZ, or, you know, I don't know. It's hard going off my head, but it's really like what I found the more I traded is I did so much better by just saying, I'm okay passing. I don't want to play the 95th percentile setup. I don't want to play the 98th percentile. I don't even want to play the 99th percentile. I want to play the 0.1 percentile or 0.01 percentile and get all those things stacked in my favor, and then just size up all the risk I would have allocated to the shittier places and just put it there. And I really think that if most traders did that, a lot of break-even traders would be profitable. A lot of unprofitable traders would be break even and so on. It just helps so much. So let's see. So then he also asked, do I treat any breakdown setups differently if they're short sell restricted? Example being on GL, how some of the opening range breaks were traps compared to how clean. Oh, so those are on different days. But the general question is, do I treat stuff differently if it's short sell restricted, meaning down more than 10%, where you can't hit the bid to get short, you need to get taken on the offer? I don't view stuff in short sell restriction mode to be that different. What I will say is sometimes on the box, you get a lot of kind of idiosyncratic things due to that market structure where you'll get all the offers pegging down. Then once those offers get taken, it kind of just sprays up and you get those vacuums. So especially from a scalping perspective, short sell restriction mode was something that made scalping really interesting because there would be a lot of times where you would get some offers, maybe some headline comes out or people are panicking and it's being pegged lower. And especially if you have all the ECM books and the depth of book and you're hyper fast with good software, you can be, okay, the 200,000 shares are becoming 100, 50, 20, 10. Then you can be the person that takes the last 10,000 shares, especially if you have good bids right there. And generally once that liquidity pegging it lower, boom, then it gets taken, you get a high probability pop. And so as far as scalping, I used to do a lot of playing that market structure with that. But as far as like charts and stuff, I don't think about it a ton other than if some level is going to break, I know I need to be really quick to get in that order queue. So the other thing too, as far as market structure, you guys really want to, like, this was such a, so many people never took the time to read the literature on different market structure things. And this could be for imbalances. This could be for add deletes. This could be for halts. This could be for short sale restriction mode. It is your job to know what orders take priority. If I'm trying to get the closing print, what orders get priority? If I'm trying to get the opening print on a halt, what orders get priority? If I'm trying to be get taken in short sale restriction mode, what orders get priority? And so many people would not do the legwork on that, and then they'd complain, "Oh my God, why can't I get liquidity on this?" And so their loss was my reward, because I'd be sitting there chuckling like, "Yup, I did the research." And so, for example, in stuff like short sale restriction mode, unless you're between the spread, you want to be visible. If there's visible orders at, say, $3.50 and you're hidden at $3.50 and somebody's taking the liquidity, the visible order is going to get it before the hidden order. And so there's a lot of nuances with market structure that you want to learn. And especially if you're an imbalanced trader, there's a lot of just exchange literature. NYSE publishes literature, NASDAQ publishes literature on how those imbalances and auctions work. There are times where getting prints can be super critical. Let's say Golf Lima opened at 35, or say $25. Do you know what order you need to get priority on that print? If not, this is the literature you want to Google and read and memorize and take notes on. Do you know when the level 2 bands, not the level 2, do you know when the limit up, limit down bands expand? Do you know what the erroneous break prices are? Those are all little things we would have memorized and kind of just printed out by our desk, and it's useful if it's relevant to your trading. If you don't do any of that stuff, okay, who cares? But for other people, yeah, we're thinking about. So let's see. So then Tehran asked, I would love to know your thought process to determine how big can you get in a stock. So it really depends, I think, mostly the liquidity, then your own risk tolerances. For most traders, the liquidity you can get is probably going to be more than you need. Like on stuff, especially on swing trading, the main benefit of longer time frame trading is the liquidity on a longer time horizon becomes infinite. But in my opinion, there's more variance with all that. So in something like Golf Lima, it really depends how these plays set up. And that's going to be true for all sorts of things. The more liquid a play is, like if you were to take something like gold, in theory on gold on Friday, gold is an instrument where you could have gotten effectively all the liquidity you wanted, right? And that includes in the options. So one thing that people don't realize is the options market pretty much just gets totally just delta hedged by algos. So there's really no limit even in the options market to how big of a position you can get, just because it all just gets hedged out by the algos. And so on something like gold, you can sell any amount of calls, you can buy any amount of 0 DTE puts. So it really just depends the play. It depends also how good you think it is. There's some plays where in GL, anything between 38 to 42 is pretty amazing, and I don't mind slippage. If I can't get filled for 20 cents, I don't care. There's other capitulations where if I can't get filled for even a couple pennies, I don't want it as much. So it really depends the play. What else can I tackle for now? Any other questions for me before I go back to those general questions? Yep.
Oftentimes in trading, we hear that like the idea that the trend is your friend or the easiest money is with the trend. But I was just wondering why you think that is. Like I know there might not be one right answer, but just your opinion.
Yeah, I mean, I definitely think it's true. And I think that is because that's a good question, but I guess I would say it's generally because I think things that are trending tend to continue trending. And let me rephrase this. for most things aren't trending and most things are noise. So if I were to type up the average ticker, I mean, what's something dumb I can type up? Let's see if GM's done anything interesting. So GM, I guess, like overall has been going up. And so I think for the most part, like big picture trends do tend to kind of continue. And I think also the trend also allows you to have a stop more easily. So if I was, it really depends how you structure things. But I would say most things that are trending do tend to continue to trend that way. So I think it helps your probabilities. And I think the more in play something is, the more that tends to be true. And so if we were to take something like, I don't know, like MSTR exploding, the urge, I think, for most people is to be like, oh my God, short this, it's at this divergence. But like, even though it's diverging, these trends tend to just go way, way, way further than people expect. And if you're just shorting blindly, you can really get in harm's way. And so what I would say though, is like, that being said, it's different if you're using the counter trend. So I would argue that, being part of the counter trend still counts as being with the trend. So what that really means is waiting for the turn. So what I don't want to do is like take gold. Gold is just breaking out. Like what reason do I have to short it at 195, 196, like the trend is just, it's breaking out. The trend's going that way. I don't want to fight that because I do think things that are breaking out and in play tend to continue that way. We consolidate, then we break out again. There's no reason to fight this trend. Like, look how long this held prior bar lows. Even though this is just boring, shitty gold, if I shorted here thinking, oh my God, gold is up 10% since a couple weeks ago, or like, you immediately just get hosed. So I think there is something to just the probability spectrum and not necessarily having a stop when you're fighting the trend, right? If I'm just shorting, not waiting for any counter trend, what is my stop? And again, I'd argue the probabilities are bad. So I'd say that's kind of like, it's for whatever reason, things do just, you being the trend is going to, with the trend's going to keep you out of trouble, help your probabilities and everything else. The only time I want to fight the trend really is after a capitulation. Right? Like whether it's this GLD here, or whether it's the Gulf Lima, or the one chart that I always love is this GOF on the huge panic. Only a capitulation is what leads to that total flush out and share turnover that lowers the average. It just totally changes the average price of the holders and the psychology. So all the people that puked this out at 11 or 12, now it's people with the cost basis. Instead of at 16, everyone's cost basis is down here. So only after big capitulations do I think the odds are way on your side for then the counter move. So yeah, I think for most people, it just allows you to have a stop. It allows you to stay out of trouble. It keeps your probabilities on your side. So overall, yeah, I do think that tends, and a lot of trends do continue for just way further than people think.
That makes sense. Thanks, Lance.
Yep. Anything else for me now before I address a couple of these other questions?
Hey Lance, I had a quick question.
Sure, Kim.
Hey, so let's say you see a pattern that looks pretty good and you want to research it. So how in depth do you go with, do you look at like, so, you know, you might record the volume around that time, the point move and things like that. Do you also kind of document like the candles before, after, like how in depth do you kind of go? Because I'm looking at something and I just didn't know if there were things I'm possibly missing, or, you know, I just was curious.
Yeah, so I think the answer is you kind of want to, you don't really know how deep you need to go, but like the best way is kind of to try to logic yourself through things. So if we were to take, so when I first started studying M&A headlines, merger and acquisition headlines, I didn't really know what drove how far this headline's going to go. So I just had a blank slate and I had no idea. And so what I started to do was I would just simply document them. Okay, this stock had this headline and it went up however much percent. And I just didn't have any views or biases. But then as I started to get enough data points, 20, 30, 40, a pattern started to emerge. Like, oh, wait a second, like biotechs tend to get bought out at huge premiums. And then you can even say like, okay, like, is this true? Is there a good reason for this? Then you can start Googling it and say, does this make sense? And so what happens with biotechs is generally you have these huge pharma companies that are multi-billion-dollar pharma companies. A biotech is normally super small, kind of smaller cap company. And for them to buy the whole company at a huge premium is really accretive for all of them because they have the marketing and the pipeline and everything to turn the drug into a success. So they're willing to pay 50% premiums, 100% premiums. And if you look back historically, biotechs have the highest premiums in the market. Okay, that makes sense. Now, if you take a boring company, say like an insurance company or whatever, an energy company like oil and gas, really, they have no premiums right now and haven't for a long time. And that's because there isn't the same meat on the bone. They're boring companies. So tech, though, is probably second. You know, biotech is highest premium. Tech, depending the subsector, is the most. Then I don't know, more traditional stuff is less premium. And so that was one way to think about it. Then I also noticed that there's different strengths to the headline. There could be a company that is exploring sale. That's kind of, I eventually learned, step one. And so what I learned from reading all these articles is there's multiple stages of a company being sold. You can be exploring sale, you can be attracting interest, you could be receiving takeover offers, you could be in advanced talks. And then, of course, a deal happens. And so I was able, by looking at 20, 30, 40, 100, 200, 300 data points, that it's this mixture of all these different variables. How many suitors? Is it a PE firm that's looking to buy them, or is it a synergistic play? And you build this framework by looking at that. And so one thing I was going to potentially make a video on, but I ran out of time, is so let's look at this DJT. So when I look at this chart, obviously this stock has exploded a ton. So there's a couple really big days. I'd say this day, 1-16 is interesting. This 1-22 is interesting. And this day here. These are the three things that kind of stand out to me just because they're the biggest bars. And this, like DJT wasn't doing anything. And then this happened. So what I'd want to do is I'd want to look back and figure out like what happened on this day? What happened on this day? What happened on that day? And I actually don't recall. I think this was when Trump started to, something changed his odds. I don't remember what happened, but I believe that's what happened here. And so this is when this actually became DJT from DWAC and everything. And so in a momentum name like this, like I actually thought that the overnight this day, when we closed so strong like that into the conversion, that's kind of an interesting point to think about. So maybe I start to collect data on that, or at least for this ticker. Now there's another thing that's kind of interesting to me, is this stock now has been in a huge downtrend, right? We've held prior bar highs for literally 2 weeks now. And so something else catches my eye. This topped at the highest volume day, right? This volume was crazy high. Even the prior days were high, like, right? We normally weren't doing that much volume, but now we're doing like 10x, you know, like 20x volume on this big day and multiples of the prior days. So that's an interesting data point. So I'm going to say to myself, wow, like how often do we get things that top or bottom on the highest volume? So now let's see, right? So if we want to talk about, you know, GL, right? So far that has maintained that, and it's been the highest volume. GOF has maintained that, and that's been the highest volume. What else? GLD that we were talking about. And so once you start to collect these data points, you see that like, okay, the huge volume capitulations tend to kind of hold. And so that's why I would have been, like I started this call, I would have been eager to short into that pop. And so now another thing that's interesting is, again, say I want to test something like break of prior bar lows post a capitulation like this, right? We've got the high volume, but we haven't broken prior bar lows. I can just collect this as a data point and say, okay, this is my entry. I'm in theory risking 8 points or so. Well, I guess initially probably 10 points. How does this pan out? And you start to collect data points. The other thing that's interesting to me is this day, this had news. This was when it turned out that DJT is operating at a massive loss, yada, yada, yada. And what's interesting is this essentially went from 80 to 45. And here's the days where we're barely able to balance. So then I might want to test what happens when we break this $45 low. Is it a feasible system to short this $45, then use prior bar highs as a stop? And yes, yes, this is retrospective and this is backwards looking, but that's how we just collect data. I'm not saying there's going to be any edge there, but it's just how we start to assess it. And so another thing we might ask is, like, let's look at this Golf Lima. What day was this again? On the 11th. So like I pointed out in the original video I made, this ended up holding that moving average for a really, really long time. So I don't know whether this is going to work, but I might try to collect data points on plays like this and see, is it worth me giving a stop of this moving average? There are people like Christian Kouamagi that use moving averages for that stops. So this is a long-winded way of saying, like, you really just observe and you want to use ideally some type of stuff that's grounded in logic, where it's like, okay, if something's trending and it's trending steadily, it wouldn't make sense that if you can use the stop, and if we break that might be a change of trend. And so I would really just try to suss out any variables that kind of make sense. And even if they don't make sense, after enough observations, you just start to notice things. And it's one of those things where it's like, okay, I don't know why it rains, but if there's people walking outside with, even if it's not raining, if there's people walking outside with a bunch of umbrellas, it could be totally sunny. If people are walking outside with umbrellas, I don't know how the weather works, but I can infer that, like, oh my God, it's probably going to rain later and it's in the forecast and everybody else saw the forecast, but I haven't. So I need to potentially have an umbrella too. So it's like, I'd really just kind of be looking at the in-play stuff, thinking, what are the variables, what's happening, what's causing these moves. And that's even how, like, you can reverse engineer some of the the episodic pivot things. Like, if you type up SMCI. Oops. Crap, I messed it up.
Hey.
And so even if you look at this, so what's interesting is generally things capitulate on the highest volume. But what happens if there's not what if it's just day one news event? Day one news is not the same as capitulation. So what does it look like when you do crazy, crazy high volume on a day one news event and you're breaking out? So it's starting to add all those variables. So if we look at some of those semis, it's not that it's just news, right? If we look at ARM, SMCI, NVIDIA, and then we were to backtest, what happens not just to a breakout, but what happens if it's an all-time high breakout? What happens if it's on news? What happens if it's on massive volume? What happens if we close strong? Those are the things I would start to look into and then say, okay, what are reasonable assumptions? What are stops I could give? Maybe I give it to the moving average. Maybe I give it to the lows of the day, and just all sorts of kind of just assumptions and stuff. Does that kind of help with all that?
Yeah, definitely. Thank you.
Yeah, and it's hard without specific examples, but like I'd say a lot of edges that I've found over time, most of them really come from like saying, what made a really big move and how can I work backwards and figure it out why? And so I do think there's a lot of like, even if you know nothing and you're starting from a ground start, like, okay, what are the things that kind of stand out? Like this bar started the huge move, and this bar is a standout. So I think like, okay, why did this bar happen? Why did we have a bar where the stock dropped 30%? And then you could start to see, if you catalog a lot of these, okay, there was no news on it. But the reason why it might have happened is, wow, look how far high this went. Look how much this had run up. And you would find that the more run up a stock is, the more exposed it is to a really big drop. And I'd say like a lot of that just comes from observation. And then you could also say like, just, so I'd say like the main things: news versus no news. What does the volume look like? What does the close of it look like? So on stuff like with news, these prior bars don't mean that much to me, just because this news catalyst just changes the whole thing. But on stuff where there isn't a news catalyst, like on this capitulation day, I very much care what the bars were doing these days. And but a lot of that kind of just takes, it depends what you're back testing, what you're researching and stuff like that. And a lot is just collecting the data points, and like the more you look at stuff, the more things are going to just start to make sense. Even though that's kind of like a unsatisfactory answer, a lot of this stuff just comes from looking at like a zillion charts and just collecting the data. And right, even if we take that Golf Lima, so what would happen is these would get defenses overnight, and you'd come in the morning and you'd be like, oh, Golf Lima's up 8 points, came out with their rebuttal, got a defense from the sell side. And you would see that enough times where then you say like, wait a second, like, should I be overnighting these? Then the next step to do that is to collect the data. And then you go back and you find the ones that really just got utterly crushed, and you start collecting that data. So most stuff that I find has always just been from observations. Hot IPOs. It makes conceptual sense that a really hot IPO closing strong might have overnight momentum. But a lot of that whole idea also came from the next day you see the hot IPO gapping up a lot. So a lot is just being very curious and observing, and just asking questions like, why are things making the moves they made, and really focusing for the hyper in play stocks. Cool. Anything else for me now before I take maybe 1 or 2 questions for now? Okay. So one question from Arjun. From your observation, what motivates the elite traders to keep pushing versus someone who is content at lesser amounts? Money aside, typically, what is their why? I think it really depends on the person, but I think the people that really make a long career out of this are people that avoid the comparison game and competing with each other. And they either love the scoreboard, where they view P&L and money as a scoreboard for success. And they're not really playing it even for the money, but they just want to see how high up on that scoreboard they can get. And I think there are also people that just really, really love the game. They love seeing how much changes each day. They love the challenge of refining and competing in the market. And so there's people at Shark, like Shark at SMB, where he's got enough money to not be working, but what is his why? His why is he wants to see just how good he can be. He knows, like Andy Kirshner, the owner of Kirshner Trading, is a huge trader. You know, he has a lot of 7-figure trades. That's a normal trade for him. And so, like, when you see and expose yourself to really big whales and you see what's possible out there, it's so good to just say like, okay, I want to see just if I can beat that. And I think it's important, not for the comparison game, but I think as far as motivation, like, you always want to keep someone in mind a couple levels ahead of you, not to compare yourself, but just to know that that's possible and to strive after. And while I hate some of like the useless P&L sharing that happens online and all that other crap, it is good just to know what's out there, right? It's good for me to know a Lucas exists where there's always bigger out there, and it just shows you what can be done. So I'd say, yeah, the people that it really ends up mostly being an intrinsic motivation to just, I don't know, just excel at something people love. Yeah. All right. I think that might be the good chunk. Any other questions before I wrap this up? Anything under the sun that I can help you guys with?
I have one.
Yep, let's do it.
In your daily report cards, I saw that you did a meditation. I was just curious about it. I didn't know if that was more of a time for you to get clear in your mind and not think of anything, or were you visualizing trading and how you want your day to go? So I was curious about that.
Yeah, sure. Yeah, I've always been a kind of a lazy meditator where I think that the practice probably is useful and it is enjoyable. And I think the biggest thing is, especially the way I'm wired, my mind just doesn't stop. It's very, very hard. And trading as a career definitely did not help. I don't think running a trading office and being a trader and doing a zillion things that are all hyper dopamine, like boom, 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 really helps quiet the whole monkey mind. And so I don't really have any, my main purpose with meditation is really just to try to calm my mind as much as I can. And I think this is even just good for sleep and everything else, where we're just so tuned into notifications, phones, tweets, this, that. What's the market doing? I'm sure every single person here checks the market at least 20 times a day, if they're not just trading all day. If you're out for lunch or whatever else, I know you're on your Thinkorswim app checking it. And I was the same way. And so I don't do any visualization or anything crazy, so much as I do try to just take that time and just focus on the breath and just keep my mind in one spot, which I'm exceptionally bad at. And yeah, I think I also find that when you don't have those checks, at least for me, given how I'm wired and how my days are, I find that taking those mental pauses, it just really helps my peace of mind and quality of life, where I think you can feel so rushed and so frantic and, oh my God, this trade's the biggest thing in the world. And it's also the same for getting outside. I find if you just take a couple minutes, 5-10 minutes to pause and meditate, or if you take 5 to 10 minutes and just walk outside and get some sunlight, both of those things just give you so much perspective for some reason. So I do try, like every morning, I try and get outside and go for a walk without markets or whatever else. Maybe I'll listen to music or a podcast. And then at least once per day, I try to just, I don't hold myself to a timer. I'm not strict about it. I'm not good about it, but I try to do 5-10 minutes of just breathing and calming down from all the demands of the day.
Hey, Lance, could I ask, if there's not enough time on this, maybe you do a write-up on it, is how best to run a trading pod? We set one up. I know you helped to kind of get it going. I've got, maybe 5 or 6 folks from the Patreon on there. But in terms of, what should be covered? Are there certain topics? There's certain expectations you should have for the members? Do you boot people out if they're not contributing? You know what I'm saying? Like, what have you seen best way to run those?
Yeah. And I think this is where like finding the people that are going to kind of self-select and I know like Neil and others have had success. And I think the people that find success are the people that are willing to do the work without expectation. And when you get 3, 4, 5 people that are all happy to do the work and kind of lead by example, that's when it works well. And I think it's totally fair to set, okay, guys, these are the base level expectations. Maybe it's, we're going to be on this call X days a week, or maybe it's something as simple as, okay, as part of this group, we commit to sending out a daily report card, at least call it 90% of days. And look, as long as people are sending out this daily report card, we're all going to CC you on it. If someone's not sending out their daily report card each day and contributing for all of us to learn, no hard feelings. You're kind of just removed from the group. So I think, I mean, there's pods out there where it's people that are on Discord every single day and doing a ton, and they're doing write-ups. There's pods of all levels of intensity, and there's some where it's just they simply just CC each other on daily report cards. So I think it's really whatever is going to make sense for the members. And I do think it's worth delineating, like these are the expectations. This is nobody wants to be the asshole, but like if you don't follow the expectations and contribute, there's no free riding here. But I think the most headache is generally saved by finding the right people to do this stuff with. And I mean, is Neil still here? Neil, if you have any thoughts and you're still here, can you share like what you found successful for you guys?
Yeah, pretty much. We had probably like 10 people at one point, but just kind of like you said, setting that like minimum standard, like, hey, 90% of days you want to do DRCs, one playbook a week. And just kind of getting that baseline level set, I think is a good start. And then like like you said, nobody likes to kick anyone out, but like we've had to kick a few people out just because they're not very active. And so like, I think just for the betterment, I think that just helps everyone out in the pod, just to like kind of set that culture. So yeah, I think just those two things were the biggest for the pod I have. Yeah.
Thanks, Neil. Does anybody else have pod experiences? Like, and just out of my own curiosity, are most of you guys trading in groups or most of you all trading alone?
I've been doing both, and I think most of the time I would say I'm better like by my own because I get into group thinking and all sort of things. And like Neil said, for like the pod thing, there's all sort of people that are just not gonna commit to like do the work and everything, share ideas. So it's very hit or miss for me. But if you find the right people, I think it's extremely valuable just for sharing ideas, getting multiple views, and just building each other along the way.
And I think one thing is if you like do want to join a pod that's like active and doing the work, like the people that are just doing the work are doing the work. So like my longest standing pod, right? We probably have like 5 guys in there, and like all of us were doing stuff and posting it on Twitter beforehand. Like we were doing write-ups and we were just like posting charts and stuff like that. And like that's kind of how all of us came together, right? And like, people reach out and they're like, hey, can I join your pod? But it's like you look at their profile and they don't have anything there. It's like not many people are gonna let you in, right? You want to just kind of show that you're doing the work, and then people will just come to you.
Yeah, and I think even stuff like some probationary period where it's like, look, okay, send a DRC next 3 weeks in a row for us to review, and if so, we'll do that. The thing to keep in mind is, especially on the retail side, the amount of people that are going to take this needs to be taken super, super seriously to succeed. But the amount of people that are probably taking trading as seriously as it needs to be is not going to be as high as you might want. And so I know some people from the Patreon have started to link up. I know people from Trader for a Cause happy hours and meetups have started to link up. So finding people from these areas, it's kind of self-selecting because these are people that are there specifically looking for people to kind of group up with. And I think Neil's success is because he's linked up with people that self-selected for already doing the work without expecting anything in return. And like, there are people that are just posting, there's not many of them, right? But there are people like Neil that post write-ups online for all to read. And the key is how many people are doing that consistently? Like, if you were to ask me to name 10 people that are consistently posting good quality write-ups online, I cannot name that. And that says something. And So it's not really about quantity, but quality. And then how do you self-select even for yourself to be chosen as part of that? And I think what Neil did was so good, where he's sharing it, he's putting himself out there and saying, look, I'm taking my trading game seriously. I'm not being selfish. And when you find 3, 4, 5 other people that do that, and you're already verified, because it's like, look, this is what I've been doing anyways. I don't, even before there's anything in return. When you get all those people together, that's when it's really, really good. But I will admit it is rare, especially on the retail side. And the benefit of working for a firm or whatever else is you're kind of already just put into that environment of people that are taking it pretty seriously. So yeah, I think expectations are great. And I think also just selecting how you screen and find these people, and doing some type of hurdle and probation period to make sure, look, before you join, you got to put in the work or whatever else. All right. Any other questions for me? Otherwise, we will call it another successful AMA.
Thanks, Lance. Appreciate it.
Cool, guys. Well, thanks for your time. Thanks for all the support and, good stuff coming in the near future. And so, yeah, I'm going to stop the recording now. I know I have a few DMs I'll answer over this chat real quick, but let me end the recording.